Welcome to the TreppWire Podcast, the show where commercial real estate meets data and insights. This is a special guest podcast. I'm Haley Keene with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Stephen Bushbaum, head of applied research and analytics. Today, we're joined by Larry Connor, founder and managing partner of the Connor Group, one of the largest privately held multifamily investment firms in the United States. Larry founded the Connor Group in 1992 and has since built it into a multi-billion-dollar platform focused on acquiring and operating high-quality apartment communities across major U.S. markets. The firm is known for its disciplined underwriting, operational excellence, and performance-driven culture. Beyond real estate, Larry is also an accomplished adventurer. He served as the first private pilot to reach the International Space Station on the Axiom Mission 1 in 2022, and has participated in deep-sea expeditions to the Challenger Deep, the deepest part of the ocean. He is also deeply committed to philanthropy, dedicating significant time and resources to initiatives that support underserved youth. Larry, thank you so much for joining us today. We're so excited to explore not only your real estate journey, but also how risk, leadership, and responsibility intersect across everything that you do. Maybe we can have you, from your perspective, start with your background and how you built the Connor Group. Can you walk us through how you got into real estate in the first place and what led you to create your firm in 1992?
Sure. Failure.
I like it. It's a great motivator.
I had been in the computer industry from 1981 to 1991. We had started out in the retail sector of the computer industry, quickly realized that was not the place to be. And keep in mind, in 1981, there was this revolution called microcomputers, with Apple leading the way and IBM shortly following. So we spent 9 years growing the company. We were actually based in Orlando, Florida. We became the second largest reseller of IBM microcomputers in the state. We were also a leading provider of LANs, LAN, local area networks. Unfortunately, the industry exploded, margins dramatically compressed. It became very, very capital intensive, which we started on a shoestring, so we didn't have much capital. And I got what I would call a PhD in business. And how that translates is through failure. And the reality is you learn a lot more through failure than you do success. So we learned a lot in that 9-year period of time, and then we closed the doors. We did not go bankrupt. Actually, we closed the doors in 1990, so I'm 40 years old. I have a wife, 2 kids, and a farm. I have no company, and I'm broke. I'm actually worse than broke, because if you're broke, you have no money. In this case, I had no money, and I had borrowed from various lenders some $900,000, which probably today is worth $3 or $4 million. And I was determined I was going to pay every single lender back. So that was the problem, but the hidden gift that I had was almost a decade of being involved in an incredibly fast-moving, ever-changing industry. And so I and another fella who was not in the computer industry decided that we could start a real estate investment firm, build it a different way, and intentionally build it all with people who had never done it before. And rather than treat it as a passive real estate investment, we were going to treat it like any other high-performing operating business, based upon people, plans, and processes. And so that was the genesis for starting the Connor Group.
This is really interesting to hear, given where we're at currently. I mean, you've heard so many folks say where we're at with AI is in very much, there's some very interesting similarities to where we were at, say, in the 1980s with the introduction of the computer for how that could shape business and the economy. We're kind of doing that all over again with AI. Looking back after more than 3 decades, what's maybe changed the most for you and the industry, and what has stayed more or less a constant?
So let's talk about the constants first, or what we would call the fundamentals. Real estate, and specifically apartment communities, are about execution of a number of fundamental things, or at least that's the way we look at it. And it actually starts with something that's really not talked about in the industry, which is customer satisfaction, or resident satisfaction. We are able, by the way, using AI to real-time gauge whether our residents are satisfied. We have real-time data from the last 30 days, last 90, and that's what we focus on. Because if they were satisfied 2 years ago, doesn't mean they are today, because this is where they live. And so it's constantly changing, either better or for worse. So for example, are you happy with the maintenance technician who came there yesterday to fix your heat, especially this time of the year? Or are you happy with the office and how they handled your work order? Or are you happy with the physical facility? This time of year, maybe it's the snow, and the other time, maybe it's how the outside is being maintained. So by having this real-time information, it actually forms the foundation of one of our beliefs, which is you're far better off retaining residents than making it a transactional business. The reality is most, not all, people in the real estate apartment industry think of it as a transactional business. People move in, people move out. We don't think of it that way at all. And in fact, our whole renewal process starts roughly 4 months out with a visit with the apartment resident and determining, hey, are you satisfied? And then if you're not, addressing that before we ever talk about renewals. The difference of that is if you're really looking in the industry, and the numbers are a bit fragmented, Stephen, as you're well aware of, you might retain, depending upon the apartment community, 45 to 50% of our residents. We routinely retain 60+%. And so it may not sound like a huge number if you have 16,000 units like we do. Well, that may mean that you have to turn over 2,000 less units and have 2,000 of them not sitting vacant for 45 to 90-day period of time. So again, our whole thesis is based upon operations, and the key there is the people that you have, service, sales, management, the plans and the processes that you execute.
I absolutely love the elegance and the simplicity of that plan because, let's face it, I don't need to tell you, firsthand. Executing on that business plan is not necessarily easy or straightforward, but it's a very clear core mandate to go by. And I can tell you from being a tenant firsthand, that matters the world from a tenant's perspective for how you think about where you're living and how you treat the building. Let's face it, the turnover and maintenance costs for unhappy tenants, I can't say I've ever seen an exact stat here, but I have to imagine it's an economically meaningful number compared to happy tenants.
Yeah, so that's a good point to bring up, Steve. Here's the simple math. Somebody moves out, and let's just say they're paying rent of $2,000. I know people talk about they can turn and re-rent it and have it reoccupied in 30 days. The reality is, after doing this for 33 years, it doesn't work that way. If you're doing a really good job, you can have the people vacate, turn the unit, re-rent it, have them move in with a quality resident. In 60 days, you're doing a really good job. So let's say $2,000 a month, 2 months, that's $4,000. And let's just say you spend $1,000 in all the costs to not only turn it, but advertising and everything. It's $5,000 per unit, okay? And so then if you say, well, geez, we got a 300-unit apartment community, and we are turning 10% less units, so that's 30 units, and then it's $5,000 a unit, you just saved straight to the bottom line $150,000. And the reality is the numbers are actually bigger than that because you don't get all of those units re-rented inside of that 60 days, and or you have to provide a lower rent or a concession with someone moving in. The hidden real benefit here is another thing that people don't either talk about or realize. The fact is, if you provide great, what we call customer service, resident service, that resident will pay a higher rate than the new resident that's moving in. So for example, in this current market, if you go across the country and you look at re-rents, most markets, you have negative re-rents and negative renewal rates. In our case, almost without exception, We have positive renewal rates that are anywhere from $80 to $150. And again, if you spread that over 16,000 units, it's a massive difference from a valuation calculation. I mean, you understand the math. If you have, let's say, a 400 unit apartment community, and let's say that 230 of the residents stay, and they take a simple math, $100 increase, you just built the rent roll in a positive manner of $23,000. Well, that's $23,000 a month times, roughly 12 months. So if you round up the numbers, you're close to 300,000. Just put that at a 5 cap. Well, heck, that's $6 million of incremental value by doing one thing, keeping your residents and getting an increase.
It's beautiful. It's such an executable business thesis. Much better to me than the complexity that comes with the difficulty of a value add strategy. I'm a big believer and fan of the satisfied consumer premium for multifamily rents. Having had lived in 2 drastically different buildings in New York City myself, I was more than happy to pay that premium.
Well, to your point, are you going to move over $200 a month increase if you're happy? Well, $200 a month, that's $2,400. You can't move for that, right? And plus all the hassle of moving, okay? And so, by the way, interesting point, many people in the industry talk about, oh, it's a value add play. Well, the biggest value add play is operations. It's not the physical facility upgrade of units or amenities. And people say, well, I'm going to upgrade the unit and I'm going to spend $15,000 and I'm going to get a $250 increase. If you go to lenders across the country and say, hey, look, what really happens? They say, yeah, they spend $15,000 a unit, but we take whatever their pro forma rate increase, in this case, $250, and we cut it in half because the statistically validated numbers will tell you it's about half what their forecast is. And by the way, our experience has been that's accurate versus improved customer or resident satisfaction, then you may be able to actually reduce costs, if for no other reason, less turnover, and your revenue is going to go up both in terms of occupancy and in terms of rates.
Yeah, Larry, it's really fascinating how you've built such a data-driven operation. I think this is a good chance to pivot and reflect more on some of your long-term strategy here. You've invested and been a part of this industry across multiple downturns and different parts of the cycle. So can you walk us through your experience through cycles, and then maybe we can pivot to get your take on where things stand today in our current environment?
So, Haley, 2-part question. I'll give you, I think, a 2-part answer. So number one is, to be successful long-term, you can't stay the same. You have to continue to change and improve. And our belief is try to simplify. As you get bigger, everybody gets more complicated. What we try to do is we get bigger, try to simplify. So what may have been working for you 25 years ago may not work 10 years ago or today. It's a very interesting question about the future. We actually think you're at the dawn of a seismic change. And what is that? So let's go back and think about that time period between 2011 and 2022. 11-year run period of time. Unprecedented factor. What are they? Interest rates that the U.S. economy has never seen before. And by the way, there's a good chance in our lifetime we'll never see again, being able to borrow at 3%. The economics and the valuations don't change a little bit. They change dramatically in that kind of environment. So that's one. Two, the market is awash in liquidity. Why? Well, a multitude of factors. So you certainly had lots of stimulus, whether it's from the government, the Federal Reserve, or other sources. Two, we saw a migration for a number of investors, both private and institutional, out of the traditional equity markets and into harder assets like real estate. Well, then inside of that, you have the third phenomenon. People aren't going into office buildings and retail because they can figure out that's not a good place to be. So what do? they massively crowd into basically two sectors. Sector number one is apartments, and sector number two is industrial. So you have the confluence of all these events, and so you go from a traditional marketplace of cap rates being, depending upon the market, depending upon the particular type of apartment community, anywhere from a 5 cap to 8. Well, then all of a sudden you keep being compressed and compressed, where suddenly you're down to cap rates anywhere from 2.75 to a 3.5, and the 3.5s are even on B type assets and B or B plus location. Couple that with, for example, here in the Midwest where we're located, historically rental rates go up, depending upon the city and the particular apartment community, 2 or 3% a year. You may have a year where it's 4%. Well, literally, you see it change and double to 6 or 8%, and in some cases, 10%. We think all of that is over. We think it all changes, and you go back to what we would call a more historically normalized market, one that maybe you saw in the 70s or 80s or 90s and into the 2000s, which is cap rates in that 4.5 to 6.5% range, borrowing cost in the 5 or 6% range, maybe some less, some a bit more. Rental rate increases, unless you're in a hyper market with a hyper location, in that 2 to 4%. Well, aggregate all that together, it's a dramatically different outcome. And so I'll finish with one thought. If you were to take a look at our returns, which have been very unique, so if you look over our 33-year period of time, our annual, this is key, annual IRR returns to our investors after fees is 30.4% annually, rarefied air. And if you look at our return to our investors after fees over the last 10 years, it's been 35%. We are saying to investors, do not expect that in the future. We are saying to investors that it's going to be significantly less. And we are generally the largest monetary investor in all our funds. Our expectation is the returns will still be good, but it's more of 20 to 25% than 30 to 35.
So I got to ask then, given where things sit today in today's environment, what does a compelling deal look like to you? What are you looking for in prospective assets out there?
Great question, Stephen. It's what we call the down the fairway property. We build all our own models, by the way, and we constantly go back, not unlike what you do, is look at all the data and analyze, hey, where were we most successful? Where did we fail? What did we learn and what did we change? So the down the fairway model for us is as follows: 325 units or less, suburban location, great floor plans, and we have a proprietary grading system based upon what we know the data tells us that residents are looking for. And so we grade out all the floor plans, whether they're 1, 2, or 3 bedrooms. We also grade out the amenities. We also look at the realistic opportunity for us to improve the bottom line or net operating income in the first 2-year period of time. And we aggregate that all together. We have a property weighting score. By the way, one of the big factors is the quality of the schools in that suburban location. And depending upon if it scores, this won't necessarily mean anything to your listeners, but if it scores like a 35 or greater, then we're going to be pretty aggressive in buying that, because we know historically those are the deals that we've done exceptionally well on. And our model, again, to finish the point, is a little bit different. We're not long-term holders. So what we're going to do is we think about it as buying a business. Okay, we're going to buy this $85 million business. That's our average that we spend on an apartment community. It just happens to be an apartment community. We're going to improve customer satisfaction. We're going to improve the operation. And then in 24 to 36 months, we're going to do a capital event. In most cases, that means we're going to sell it or we're going to refinance it. So we're going to do a very, very high transactional volume versus just this massive portfolio of 50 or 100,000 apartment units.
I love this, by the way, because the timeline aligns with exactly what I'm thinking about in my head, which is this chart that shows the distribution of hold times for multifamily and what seems to have been the sweet spot for hold times and returns. And it was, I want to say around like a 3 to 7 year period was really where you saw the most success with the line returnment and your exit strategy. So what kind of debt has been the most successful for your strategy, given everything that you've told us?
Two-part answer. If you said, well, what kind of debt do you like to have? Like agency debt where you can fix it for 5 or 7 years. But that doesn't match our hold period. So what we've had to do is primarily with banks is shorter term debt that you're either going to buy a cap on or you're going to swap the thing and you're going to try to match it to the hold period, whether that's 2 years, 3 years, things like that. We rarely will float naked. We'll buy some type of, hedging strategy. Now, the problem with that is that your interest rate costs will be higher than agency. But again, it's about the time value of money and the time period you hold it. And so if you model it out, let's say you buy a great property, suburban, 300 units, great floor plans, great schools, great amenities. Even if you do well, you hold that deal for 5 years versus what we call re-engineered the operation and improved it and sold it in 2. Invariably, you're going to have a substantially higher return on the 2-year versus the 5-year because literally you've held it for less than half the time. So it's the time value of money.
I love it because the optionality that term and cap structure gives you is so incredibly valuable for your business strategy. So I love getting that insight into your debt structure.
By the way, let me give you one other. That's assuming that you execute your business plan, which we have a plan on every single, again, we think about them as business. And keep in mind, these are not inconsequential businesses. I told you our average acquisition is $85 million. So we're buying a really valuable business and you got the plan. But if you don't execute that plan, it's so time sensitive, your return really goes down. And honestly, sometimes we don't get it right. Now, we're good at owning that and recognizing it and fixing it, but sometimes the 2 years turns into 3.5 or 4.
But it sounds like when you acquire that asset, your team is hitting the ground running. Maybe sprinting is the more appropriate term to get things right.
Yeah, as they would call it, the pace of play is pretty exceptional. And that's why, again, our model is we don't hire anybody from the industry. Regional heads, managers, we call them GMs, sales, and most service people we bring because our model is so different. We have to kind of home grow our talent. So for a manager, they come to work for us. They spend 5 months in training before they ever run a property. Or in sales and service, it may be a month or 2 months to do it. And that's why our culture is so critical, that you have to get people who really want to be challenged. They want fast pace. They want challenges. They like to see success. They are at the end high achievers.
So just a curiosity I have, if you don't mind me asking, what's maybe one of the biggest misconceptions people have about multifamily right now?
That it's a passive investment, that you buy the asset and maybe you hire a third-party management company and everything is wonderful. No. If you think about a business, businesses have revenues, they have expenses, they have personnel, they have customer service, they have marketplace realities, they have advertising and marketing you need to do, all these various components. Well, guess what? An apartment community has the same. I get it if you buy a warehouse and it's a triple net lease, that's a financial transaction. You have to think about, understand and recognize that you're buying an operating business that is a great business to be in and has tremendous opportunities, but you can't treat it like a passive or part-time endeavor.
So Larry, when people hear about the adventure side of your life, the space missions or the high altitude jumps, they probably are focusing on the headline. But I'd love to hear from you what the philosophy is underneath those decisions. How do you think about risk and purpose when deciding to pursue something like that?
We've been fortunate to do some kind of interesting things. But underneath that is some common themes. And so we won't really do anything unless it meets two standards. One, it has to be challenging, and two, it needs to have a purpose. And you'll see that that's cut across all of our endeavors. The other thing is, contrary to public perception, is we won't do anything that we don't believe we can do safely and successfully. So if there is risk involved, and some of these clearly have it, we have to be able to manage this risk. Or said differently, we will not take any unacceptable risk.
I love it. You talk about challenge, purpose, and disciplined risk. So maybe you can step back and look across everything you've built and share 1 to 3 endeavors that best represent that philosophy in action.
Sure. So I'm going to think about what has meaning and purpose. I would probably put at the top of the list, we have a pretty large not-for-profit called the Connor Group Kids in Community. We've done a number of very unique things, both regionally and nationally. It's a continuing to expand endeavor in a couple of groundbreaking areas. I'll give you one example. We built the first private school that's non-denominational ever done in the state of Ohio, exclusively focused on under-resourced kids. We've been operating that for about 4.5 years. And what we've been able to do is, and again, it's about a team of people, nothing short of remarkable. And that's a model that is being looked at in cities across America as a revolution in how you can approach educating the future of America, we believe, which is our kids. So I would say that's one. Probably the second one is the Connor Group. You know, we started out, we had never done it before. I mean, you could argue we didn't have a clue what we were doing. There may be some truth to that. That may have also been an advantage. If you look at the returns we've been able to do and the successes we've had, not only for ourselves, but our associates, our investors. Right now, we have a firm of about 400. Over 70 of those people are actually equity owners, all through sweat equity. And in a number of cases, they make as much from their partnership ownership as they do from their salary and bonus. So that would say probably number 2. And then number 3, it's very hard to pick the endeavors we've done, but I would look at it this way, that we've been willing to try to do what seems maybe impossible to do, and we've been fortunate enough to have multiple successes in that arena.
I like that. I just recently read a piece about some of Raj Chetty's research and mixed income developments and trying to improve generational outcomes for underserved youth. And at least from my perspective, it sounds like some of the stuff that you've done is right in that arena, just massively impactful. It probably doesn't get enough research.
Well, that's the problem, by the way. We have lobbied in Washington and here in Ohio. By the way, Ohio's been very receptive, that the future of America lies in our children, and that the public school system, in our view, is broken, and that we don't need an evolution, we need a revolution. There are people and strategies out there to do that. And don't think for a moment that kids that are under-resourced aren't every bit as capable of achieving like kids from the suburbs. The reality is it's simply a matter of the right people, the right plans, and the right funding. By the way, as an adjunct to that, we are a pilot project for a AI strategy where AI becomes the individual child's tutor. And because at our school, every single child has an IEP, individual educational program, it's a natural transition whereby they're literally just using their Chromebook, and that AI tutor is talking to them and getting to learn them and know them. And while the data is early, it is stunning what the potential is. We're not there yet, but I think in another year or two we'll do it. We can increase the effectiveness of our teachers of our school by smart employing technology.
This is exciting to hear because I'm just imagining from a real estate context just how wildly impactful some of these programs could end up being for underserved areas, the kind of development we'll see take place. It's exciting stuff.
Yeah, but you got to have resolve. And hopefully, as I started to allude to, both from a federal and a state level, and we are seeing certainly greater awareness in hey, look, you got to make the investment in it. It hasn't been politically necessarily at the top of people's priority. We think it's becoming more so, and hopefully that'll accelerate.
So, Larry, let's zoom in on some of your missions and adventures. Maybe you can walk us through a few stories that really stand out to you, whether that was because they brought risk and purpose, or it was just something interesting that you've experienced in your lifetime.
I can certainly give you two, one kind of more of human interest, and then maybe one more of getting close to the edge of danger and then managing through that. In 2022, we embarked on a mission called AX1, first all-private civilian mission to the International Space Station. And I had the good fortune of not only being on that mission, but being the pilot. By the way, I have to be honest, though, the pilot deal is a little overrated. It's a SpaceX Crew Dragon capsule, really automated, and SpaceX is a phenomenally talented company with all kinds of safety measures built in. We took a 19-hour journey from Cape Canaveral to the International Space Station and successfully docked. And the mission was planned for 10 days, but it's complicated when you're going to disembark and re-enter Earth's atmosphere and splash down. A lot of things have to be aligned. So we ended up being there for 17 days versus 10. And so it gave a great opportunity. And a little known fact, there is a telephone system there that Cisco actually developed. And keep in mind, you're circumnavigating the globe every 92 minutes. So you literally go in and out of darkness as you go around the Earth every 45 minutes. And depending upon where you are, the system either works perfect or it doesn't work at all. So because we had been very, very heavy on research, doing over 225 hours of research in our first kind of 10 days there with research partners that I had, such as Mayo Clinic, Cleveland Clinic, and others. So we were working like 14-hour days. But in the last 4, 5, 6 days, we had some free time. So I started calling people. It would ring on someone's phone, and it was a Houston area code. I think that's 242. And so it was really unusual when people would pick up, and so I would say, whoever, hey, Joe, greetings from the International Space Station. Well, the vast majority of it, almost to a person, nobody had ever called them from outer space. I didn't realize it at the time. It was like, I ended up talking to about roughly 40 different people, and I'm like, well, geez, I got this free time, I'm gonna call them. How impactful it was, especially for kids, and that how many people actually saved that message that I left for them if I didn't actually connect with them or talk to people about it. So it is a different experience, but literally, if I was talking to you, Haley, you'd think I'm just on a cell phone calling you. A little known fact about the International Space Station. A different one is in 2023. This actually started in 2022. Part of the people who provided rescue support for the AX1 mission were a group of former Air Force pararescue special operators. So I got to know them as part of our training if there was a rescue and they had to do an ocean rescue and everything else like that. So right after our mission finished, I was talking to them about I'd always wanted to do a halo jump, a high altitude skydive. And so we started talking about that and what could we do. And again, when you kind of think with no boundaries, you can come up with some pretty creative things. So we decided to build a hot air balloon. We built the largest hot air balloon ever built in the United States. It was about 12, 13 stories high. Actually, a company, believe it or not, there's only really 2 companies in the world that can do that correctly. One in England, the other one in Ann Arbor, Michigan. And they did a phenomenal job. We spent months and months in training. So myself and 4 Air Force pararescue special operators took that to Roswell, New Mexico, because the temperatures and the winds are very good. And we flew that thing to 38,000 feet. By the way, it's an open basket or gondola. Nobody had ever attempted to do that. And we stepped off there, did a 5-man formation, did multiple records. And one of the, I can probably report it now, but one of the unreported things was we were at, and we lifted off, and you would think it'd take a long time, but it only took about 55 minutes to go from the ground to 38,000 feet. We're all on oxygen, of course, individual masks, and my oxygen supply froze at 33,000 feet. And that's a problem because you can't take off the mask, and if you can't breathe, about your only option would be to jump off of the gondola and hope you got down to altitude before you were unconscious. So I had a bit of a trying moment then until I'd remembered somebody had told me in training that if you kind of tilted your head and kind of shook it, there's a valve there and it might have become frozen and it might release and unfreeze. We had, by the way, a real world kind of renowned O2 expert guy, and I'm trying to, obviously you can't talk, so I'm pointing to him like, hey, I can't breathe, I need some help here. And fortunately, I kind of shook the thing, and all of a sudden I'm like, okay, I'm good, I can breathe again now. When you're going to do something at the very edge, and certainly going there, we were at the very edge of being able to do it successfully. There are things that happen in life. And there it's gotta be, okay, stay calm, let's figure this out.
Oof. Yeah, that one's tense. Just for me, imagining that exact situation and probably what's going through your minds, and not even by the second, but by the millisecond, evaluating options and troubleshooting. That's amazing.
Well, thank you, Larry, for sharing. I mean, it's clear from this podcast episode, you've built an incredible business. You've given back significantly, and you're pushing human boundaries. So maybe we can leave our audience with one final piece of advice from you. For anyone, maybe they're just entering the industry or they're building a company or just trying to live life more intentionally. What's a piece of advice you may have?
Aim high. Do not self-limit. You and your mind are capable of much more than you think you are. Think about it this way. You will never outperform your own self-image. So even if you're not sure you can do, at least if you say, well, maybe I can, I believe I can, and I'm going to try, you're well on your way.
I love it.
I like it.
Thank you so much, Larry.
All right.
If our listeners want to find out more about the Connor Group or learn about your philanthropic initiatives, how can they reach out or find out more information?
Sure. The best thing to do about the Connor Group is our website, which is, just Google the Connor Group. And if they're interested in the Greater Dayton School, we have a website for that, literally the Greater Dayton School, and you'll find out some hopefully worthwhile and very interesting information about what we're doing, the mission we're on, and the success we're having.
Excellent. Well, thank you so much, Larry, for joining us today. This has been an incredible conversation, and we look forward to following everything that you do next.
All right. Thanks, folks. Appreciate it.
And with that, we'll close this special podcast. Thank you, Larry, for joining us today. Join us later this week as we look at what's happened during the week and how it may be impacting you. If you have a question or a comment, send us an email at podcast@trepp.com. Until then, visit trepp.com for more info and subscribe to the TreppWire Podcast with your favorite provider. Thank you for listening and stay well. All right.